bin hier.
Right, let's go. Okay, welcome back. After a fascinating, if rather daunting, session on the scale of the economic downturn we're facing or could be facing, and the potential obstacles to a rapid recovery, we now turn in this session to the financial system, the state of which will have a critical bearing on that downturn and the speed of the recovery. Title is Corona Financial Crisis, Crash and Debt Towards Another Meltdown. The collapse in economic activity and the unprecedented certainty over the timing and strength of the economic recovery has led to real financial stress. I mean, quite unprecedented stress. Big falls in asset prices, commodity prices, and very serious volatility as it's become hard for people to price risk. But the collapse in economic activity has also exposed various other vulnerabilities. I mean, one is clearly the unimpeded rush into dollars, US dollars, which has been causing very serious problems for emerging markets. And these problems are happening simultaneously. Typically, we have a couple of emerging market crises, or in the financial crisis of 1997, a lot simultaneously, but we've never had crises in this many big emerging markets at the same time. Another is the fragility of financial institutions' business models and how they use their systemic importance to sustain or to maintain these models. Basically, in good times, they tend to produce too much credit and debt, and in crises, they contribute to panics as their creditors lose confidence in financial institutions' financial solidity, and those institutions rein back credit too quickly. Now, the weakness of banks is clearly of great concern given the prospect of serious balance sheet problems on the part of a lot of firms, which we heard about in the previous session, and hence the prospect of a wave of insolvencies. In the Eurozone, we also have the particular challenge, at least a particular challenge for developed economies, of banks facing the possibility of problems or default on their holdings of sovereign debt. Now, can governments and central banks head off a renewed financial meltdown? And what is needed to boost the resilience of the financial system or our financial systems going forward? The format of this panel is slightly different to the ones we've had so far. We're going to kick off with a presentation of a paper by Finanzwende, basically looking at scenarios for financial markets and financial systems going forward. Gerhard Schick will provide some introductory remarks. Then Joscha Wullweber, one of the two authors of the paper, together with Voss, will present the paper. If both of you are going to say something, no problem. Just indicate that. Following that, we have two discussants to respond to the paper. One is Holger Schmieding from Berenberg Bank, and the other is Dorothea Schäfer from the DIW Berlin. Gerhard, over to you.
Thank you, Simon, and good morning to everyone. I hope you have had a good coffee break and your coffee was delicious. We started a project, Transformative Responses to the Crisis, in order to have a look on what can we do to not come back in that situation that we had in 2008, where the crisis saw many discussions of what should be changed, but later on, change was difficult to achieve. So we launched a 3-year project together with Heinrich-Böll-Stiftung and other foundations to make sure this crisis actually leads to transformative responses. As last time around in 2008 and following years, civil society was not really prepared to fight for good transformative responses. So this study that Joscha Wullweber will now present is the first step in the work in this project. We will look at financial markets and their fragility. Intentionally, the idea was to look at different scenarios, but now all scenarios have converged, of course, in what happens with the corona crisis, the lockdown, and the effects on financial markets. So we will focus on that. It's very difficult at the moment to foresee what will come next. But of course, balance sheets of banks will get under stress, and we'll have a look not only on the past situation, but also some risks that lie ahead. And I pass on to Joscha Wullweber, which I thank for presenting this study.
Thanks, Joscha.
Yes, thank you, Gerhard. I'm really happy to be here with you, at least virtually, at this super interesting workshop. And I also would like to say thank you to the organizers, especially those working in the background, making this workshop possible. And I also would like to say thank you to Dorothea and Holger, who agreed to serve as discussant for this paper, and all the more that because they received this report at a very short notice. So what is the report about? So we've looked at global financial instabilities and the performance of the global financial system. Our question was about why did the system not react more resilient, and why was the system not able to absorb the crisis? So in the report, we identify different instabilities in the global financial system. However, for the presentation today, I would like to first draw on stages of financial instability based on Minsky and Kindleberger and apply these stages to the current COVID-19 financial crisis. And second, I would like to focus on one major source of financial instability, which is the shadow banking system. Yeah. So the very first stage, which is then after the global financial crisis, the stabilization and recovery of the financial system, was mostly due to the unconventional monetary policies by the leading central banks, such as quantitative easing, low interest rates, lend of last resort, and market maker of last resort policies. By these highly unconventional policies, it was able to stabilize the system. However, of course, these measures came with a price in a very real sense. And let's see whether you can see this point. So the balance sheets of leading central banks exploded in the last years, reaching 22 trillion US dollars at the end of 2018. Yeah. So these unconventional measures were able to stabilize the system, and then financial players started to invest again. However, the problem was that these investment activities were largely concentrated on the financial sector and to much lesser extent on the productive economy. Yeah? Nevertheless, we saw in the next stage an expansion of private credit. So increased demand for stocks and other assets, market prices rose, and increasing financial investments led to higher asset prices, which again attracted additional financial investment. Interest rates, asset prices, and the level of private debt increased strongly. What emerged then was a positive feedback loop. And to quote Kindleberger here, investors rushed to get on the train in this stage before it leaves the station and accelerates. So a boom emerges. And I just show this graph here to show this 11-year bull market in the last years, which was not based on strong economic growth. On the contrary, the productive economy never fully recovered after the global financial crisis. Yeah. Also, this stage was marked by rising private debt, concentrated, here's an example in the US, by rising US student loans and car loans. Yeah. At the same time, real wages still stagnated. Kindleberger suggests that at one point then there could be a turning point. Yeah, and indeed around 2018 and even stronger in 2019, markets became increasingly shaky because of different reasons such as America First policies, Brexit, and still an even stronger weak economic outlook. The euro crisis actually was never solved, so uncertainty emerged in the financial markets. Yeah? And then in this situation, Kindleberger suggests, you need just a specific event with a signal effect that then can trigger the next phase. And obviously that was then the COVID-19 pandemic and the oil price war at the beginning of March. So asset prices were sold, prices declined, expectation turned more negative, et cetera, et cetera. You know the story. Yeah? The financial markets in the financial markets, crisis at one point became a self-fulfilling prophecy. And to quote Kindleberg again, he calls this with the German term Torschlusspanik. He's saying investors crowd to get through the door before it slumps and shuts. Yeah. So the question is, why is the global financial system not more resilient with all these stabilizing measures by the leading central banks? And obviously there are many questions for that. In this presentation, I would like to focus on the shadow banking system, which I think is highly underappreciated area in the financial system. So very shortly, because I think it's not so well known what the shadow banking system is about. And I very much hope that we have Daniela Gabor at the next session here, but because she is the specialist in this field. Yeah? So what is shadow banking system? It is credit intermediation outside the regular banking system. And to quote Perry Murding here, it's money market funding of capital market lending. So the shadow banking system is in between, if you want, so these two markets. It's today at the center of the financial system. It has already supplemented the regular banking system. It's about $100 trillion market. Yeah? It's unregulated, mostly unregulated, and it's the cheapest way to borrow money. Investors here are actors here are investment funds, broker dealers, money market funds, pension funds, etc., etc. And the central instrument is the repo, and I explain this at the next slide. So what is a repo about? And we should really learn about that. It's already called shadow money because it's so important to understand the overall shadow bank system and the today's financial system, global financial system. So on the one hand, we have a creditor, which has an excess of money, for example, money market funds, pension funds. On the other side, we have borrowers who are in need of money for whatever reason, for speculation or whatever. What happens then is that A, the creditor lends money to B, but it's not an unsecured lending. It's a secured lending because the borrower sells a security to A at a certain price. So the creditor becomes the legal owner of security while the borrower still receives interest payments. So, but it is a repurchase agreement. That means that after a certain time, and most of them actually are overnight or only for 1 or 2 weeks, A receives the money back, plus interest, of course, and B receives the security back. So what's the problem about that? And the problem mostly lies here. It's the haircut and margin calls and mark-to-market practices. So a haircut means that the borrower must pay an extra charge to ensure that in the event of default, it will still be possible to sell the securities here on the market without taking a loss. And what is more, the value of the collateral is determined on a mark-to-market basis. That's mostly nowadays daily. So if the value of the security declines, a margin call applies. This means that the borrower has to put up additional collateral for repo transactions. In this way, the trade is constantly adjusted to the changing price situation. It comes a bit more complicated, but that's already it. Yeah? So in between, so these trades normally are not carried on between creditor and borrower. Very important for the shadow bank system are the market makers in between. Yeah? They provide financial liquidity by credit intermediation, and they provide market liquidity by trading securities. And now we can expand the definition, and I mostly took that from Daniela Gabor. So what is shadow banking about? It's the production via securitization and financing via wholesale funding markets of tradable securities based, and this is very important, on a private security structure. And in the next slide, I would like to look at this. Would like to compare the loan-based banking system, credit system, and the shadow banking system. And there's a huge difference. While the banking system is, in the last instance, in a crisis, relies on the state. Yeah, the state works in the background with the central bank, with other measures. Yeah, through statutory protection schemes, etc., etc., marginal lending facilities, access to reserves, etc. In the shadow bank system, the shadow actors don't have access, or didn't, I have to say, access to the central bank facilities. So their securities, their safety, are these underlying securities, the collaterals. So these securities simulate, if you want so, government guarantees. The assumption underlying these trades is that this is very safe, because in case that a security would lose its value, this will be offset by another security, which then gain in value. Yeah, this was meant to be highly secure. However, it's the contrary, because in a crisis, the problem is that not one asset loses its value, but that many or most of the assets are losing its value. Yeah, and then a vicious circle begins. And especially, this is especially true because of these mark-to-market practices. We have a value loss of many securities. There's an increasing haircuts for these securities. Demand for more collateral through the margin calls, increase of the price of the repos. The financial liquidity decreases. Therefore, you have to sell securities. Again, a value loss of these securities, and it's a vicious circles. Yeah. What then can happen, and what happened in the global financial crisis, and what we realized in this crisis as well, that there's a panic on the repo markets. Money markets collapse. The system of market makers, very importantly, collapses. And then the overall shadow bank collapses as well. Yeah? This puts the overall financial system into a crisis. The problem with that is that the central banks cannot serve as lender of last resort. I mean, shadow banks don't have access to, don't have a reserve account. So what happens then in the financial crisis? In financial crisis, the market makers have to be replaced by central banks. The central banks have to become market makers of last resorts. Yeah? So what are they doing? They provide credit for banks and for shadow banks in this way. Yeah? They provide safe collateral that the repo trades can go on based on this collateral, and they protect a certain price corridor. And today's financial system would collapse immediately without central banks, especially the Fed, of course, stabilizing the overall system. And just to show you one slide, what happened in the last 1.5 months with the federal balance sheet, it exploded, yeah? Compared to the global financial crisis here, it was 1.3 trillion US dollars rise in the balance sheet. What we witness right now is a 2.1 trillion rise, and it's going on. So some expect already only the Fed balance sheet to increase up to 9 trillion. So to wrap it up, what about the performance in the crisis of the financial system? Very importantly, the COVID-19 pandemic was not a black swan. Yeah? As Stephen was saying in the last panel, it is already actually the third pandemic we've witnessed in the last years. So it was not a question of, but only when this crisis will hit. Yeah? The question, not a question of, but when it will hit. Yeah. So the vulnerabilities of the financial system are very obvious, and it's mostly based on this unregulated shadow banking system, which is highly prone to crisis. And this shadow bank system makes it necessary for central banks then to step in. The problem is, of course, they can stabilize the system, but then a new crisis circle can emerge. And we already witnessed this currently. I mean, the financial markets are kind of crazy, and they already feel quite secure and start going into the speculative lending again. Yeah. So my very last slide, I have here a quote from the Federal Reserve from December 2019 in their Financial Stability Report. This report says, a stable financial system, when hit by adverse shocks or events, continues to meet the demands of households and businesses for financial services, such as credit provision and payment services. In contrast, an unstable system, these same shocks are likely to have much larger effects, disrupting the flow of credit and leading to declines in employment and economic activity. Yeah. So obviously, already prior to COVID-19, the global financial system was highly unstable. The system was not in a position to buffer the impact of the economic downturn. On the contrary, the already existing weaknesses within the financial system exacerbated the overall economic crisis by triggering adverse feedback loops and downward liquidity spirals. Okay, thank you very much.
Thank you very much, Joscha. That's a really, really excellent presentation. The paper I look forward to digesting at more leisure. Dorothea, would you like to kick us off? And do you share this analysis? Do you think the situation is as grave as Joscha has painted, or do you think that the financial system has responded more effectively than he's arguing?
You have to put your microphone on.
Dorothea, you're muted.
Ah, yeah, yes, now.
Can you hear me?
We can now, yes.
Very good.
Okay, so yes, I am going to discuss the paper. Presentation was really very good paper, enlightening and comprehensive about the functioning or malfunctioning of modern financial markets. The major conclusion in my sense are there was no true recovery of the financial system from the great financial crisis 2008-2009. Since then, the system is in a crisis modus. The central banks protected the financial system against the worst turmoil. And the problem today in the corona crisis is not the banking system as it was in 2008-2009. This time the threat comes from the financial sector. And the huge amounts of regulation set up after 2008-2009 has not the effect it has been hoped for. It did not bring stability again. So financial markets, the authors say, they showed again, are in no way capable of acting as a firewall against economic crisis. They did not curb the economic impacts of the corona pandemic. And the major sources for the financial instabilities, the authors say that the shadow banking system, the asset boom, the rising private debt load, the growing importance of exchange-traded funds, and high-frequency trading. So some thoughts about other possible sources, perhaps, from my side. So at least in Germany, we have the phenomenon that private and public saving is the rule rather than the exception, at least in the last years. And there is a savings overhang and also the scarcity of real investment projects. I heard once a guy from Allianz insurers saying that they really have an emergency of finding good investment projects. So, and still we have very attractive jobs in the financial sector, in particular in the investment banking and in the shadow banking sector. And that has not very much changed after the financial crisis. So financial sectors have still enough manpower, and if manpower is there, financial activity is high, probably too high, and that the shadow banking system is maybe just a mirror of that. The financial sectors are still large, and the shadow banking sector was ever expanding. So we had no reallocation of jobs to other occupations after the financial crisis. and no strong reorientation of the human capital investment. So the echo from the Corona shutdown, some say that banking crisis is ahead of us when all the additional liquidity loans will create a debt overhang and threaten the stability of small and medium-sized enterprises. The perception so far in Germany, I think, is at least in some parts of the professionals different. For example, yesterday, the idea of an European bad bank proposal came or went through the newspapers, and the proposal is from the ECB, and it was commented in this way by Gerhard Hoffmann, the CEO of the German Association of Cooperative Banks. And he said, the proposal of the ECB suggests that the next banking crisis is on the door. And this signal would be fatal and could raise additional fear. So in Germany, there is the perception that we have a banking crisis ahead is not there yet. So some other open questions. We have the puzzle, at least in Germany, that firms on aggregate were savers, as were the state and private households. So the question is, will the liquidity loans really turn the saving firm sector into a sector with a huge number of defaults? In other words, a previously saving sector should have the borrowing capacity necessary to survive, at least on aggregate. So there is some doubt that a sector that did very well and was able to reduce its own debt that is meant by saving is now very suddenly on the brink of insolvency. So it should be solvent enough that banks prolong their credit lines. And should the conclusion from the analysis be a shrinking of the financial system or the financial sector? This is in the paper and also now in the presentation that didn't come really out, very clear out of the analysis. What about the mostly very attractive jobs in the financial industry then? And do we want to increase the regulatory sector? Because if in the manuscript, in the paper, it is also said that regulation is not efficient enough. So would we want to have a larger regulatory sector so to better control the very vast or expanding shadow banking system? So if yes, what instruments would we propose? So if yes, that we want to shrink the financial sector, what instruments would we propose? And the paper is a little bit silent on this side. For example, a comprehensive financial transaction tax might be an instrument to shrink the sector. Other instruments could be, for example, that you really restrict the banking or the loans from the banking sector for hedge funds, all kinds of funds in the shadow banking system. So there should be a more concrete proposal in this respect, and the decisive question is the way to go forward, the shrinking of the financial sector. The proposed solutions in the papers are central banks need to keep playing their already obtained role as lender and market maker of last resort. There is a threat that funds fail to reach the productive economy and instead are diverted as excessive reserve into the financial sector, as it was previously experienced. The authors suggest a higher equity and liquidity requirements for the financial sector, not only for the banking sector, and direct funding of the central states budget by central banks to enable government promoting the recovery of the real economy. Some comments from my side to the proposed solutions. The proposed solutions are very general. Wouldn't we need more specific regulatory proposals directed to shadow banking, asset booms, raising private debt load, the ETFs, and high frequency trading? The manuscript's focus is very much on US perspective. Wouldn't we need more specific focus on the financial systems in Europe? Because I really think that we have a quite different financial system. Wouldn't we need to focus, and that is my last remark, wouldn't we need to focus on green finance as well when we propose regulatory amendments? Thank you very much.
Thank you very much, Dorothea, for that. Holger, do you agree that the financial system is now a part or a big part of the global economic challenge we face? Or do you think the system is basically doing its job and there's a risk of us kind of shooting the messenger? So the amount of activity we see, the amount of intermediation, the amount of trading is actually still improving the efficient operation of markets, and that the actual underlying problems lie elsewhere? Or do you think quite some of what has been said so far is actually true, and that the system itself is part of the problem we have?
Thank you very much. First of all, to briefly answer that question up front, yes, there is something to what the authors argue. However, I do think they overdo their point a bit. As I mention again in a few more minutes, relative to the size of the shock to the real economy, which is probably the worst ever in peacetime, we are looking at output in April, possibly 30, and if we are unlucky, 40% below what it was in January. Relative to that shock to the real economy, relative to what we have as uncertainty at the moment, which again, outside of war, I don't think we've ever experienced. Relative to that, I would say the financial system is working better than you could have expected under those circumstances. Of course, with governments and central banks being a major reason why I would say the financial system at the moment is not really, at least not yet, part of the problem. It may turn into part of the problem, but if regulators, central banks, and policymakers continue to get it right in their financial and monetary responses, then hopefully the financial system will not be something that exacerbates this crisis a lot. Now, as to the paper, first of all, of course, thank you very much for inviting me to actually comment on this paper, which I've read and which I liked quite a lot, although I do not always agree with it. It is a great survey of the vulnerabilities in the financial system. And I'm very delighted that it goes into details of the plumbing of markets, such as repurchase agreements, where indeed you can argue in such details, you may see and expose an inherent risk of vicious circles. That's part of life. But looking at those things and arguing for an adequate regulation of those markets is very valuable. The authors compiled a lot of material on the recent market reactions very fast, excellent. And they lay out their arguments very clearly. As I understand, the authors say that the financial crisis induced by the pandemic was not an unpredictable black swan in an otherwise stable system, but that the financial system was already in crisis mode, that we already had huge asset bubbles building up pre-COVID, and it only took a trigger to expose all that. I'll tone that down a little. But before I do that, briefly, kind of my own priors for that. First of all, it simply is a fact of life. Humans overreact. Cycles of despair and exuberance, you have them everywhere in human behavior. You have that in capitalism, you have that in financial markets, you have that elsewhere. However, in financial markets, such cycles can be especially relevant because markets are huge, fast-moving, and relevant for the overall system, which is a clear argument for more prudent regulation of the financial sector than of many other sectors of the economy. And absolutely correct, shadow banking needs to be sufficiently regulated so that it cannot be used as an avenue to circumvent the regulation of the other parts of the financial system. And fourth, as a prior, indeed, economies need a lender and, as the authors have rightly argued, a market maker of last resort. Now to the question, was the financial system already critically unstable before the virus struck? That's where I have doubts. We had some excesses. Judging from the macroeconomic point of view, yes, for instance, the US corporate debt market, where fracking had excessive leverage and where equity buybacks, taking advantage of very low interest rates, went too far. We do have, of course, some issues with repo markets, exchange traded funds, algorithmic trading and the like, and market makers, broker dealers had carrying less inventory than in the past, which makes markets unstable to some extent. But banks, by and large, were better capitalized than before. And as the authors often look at the US, the household savings rate in the US is higher than it was before the 2008-2009 financial crisis. The authors show on, I think it's page 37, that US debt for non-financial businesses and households has, on aggregate, gone up, especially for non-financial businesses in the years 2013 to 2019, whereas for households, the debt to GDP ratio has actually gone down. I'd interpret that chart slightly less negatively than the authors do. First of all, the rise in the debt ratio for non-financial businesses 2013-2019 has been there. But relative to the steepness of the rise that we had before 2008, this was much more modest. And indeed, the debt ratio is high, but that in itself is not necessarily a reason for huge alarm. It is simply a feature of growing economies that on trend, your stocks, assets and liabilities continue on trend to grow a bit faster than the flows, GDP. So just saying it's a record isn't good enough. It would have to make it alarming, you'd have to say the recent increase has been so alarming that this goes far beyond the underlying decades or centuries long trend, which I would say in the years up to 2019 wasn't quite clear, even for US non-financial businesses. Now, the authors also mention repeatedly the 500% increase in asset prices, the Dow Jones in the US, since 2009, which, well, is a little bit cheeky, of course, in the sense that if you start at a trough after a huge sell-off, you, of course, get a very nice rate of increase. Starting 2007 would still look very, very strong, but not quite as impressive. More relevant, I would say, is this chart would look a bit different if you took it for the Euro stocks or the German DAX. Still up nicely, but much less of this 500%. And that is partly because the US index is, you could say, distorted by the new US tech giants, the FANGs, etc., who are reaping de facto monopoly profits from their scalable network character. To me, this is not an issue of irrational financial market exuberance. For me, although it may indeed be, I don't want to comment on any of these individual companies. For me, there's probably more an issue of a failure to tax these FANGs correctly on a global scale, and or a failure to possibly regulate them, as they are networks and should be treated more like utilities than they have been so far. But I would not really quote this aspect of the rise in equity prices as a sign of financial excess. And on top of that, when looking at equity prices, we also should factor in that probably the outlook for interest rates, real and nominal, going forward is more subdued than it typically was in the past, and hence that with your price earnings models to value equities, you have a lower factor that discounts future earnings into present earnings than in the past, and hence price equity ratios that in the past may have looked like a bit above average now should not be seen as a sign of alarm. Now, the COVID-19 financial crisis. Do we actually have a financial crisis? That's a very good question. What is a financial crisis? In my view, a bear market in equities doesn't count as a financial crisis. A widening of spreads doesn't count as a financial crisis. A real financial crisis is a sudden stop or a freezing of key parts of the financial system that does serious damage to the real economy. It often goes along with the bear market in equities, but those are separate things. For instance, in 1987, we had a huge plunge in stock markets. I was young at the time. I got a little excited about it at the time, I must say, but it was not a financial crisis. Whereas 2008, 2009 was a huge financial crisis. We had serious excesses in the US subprime, in financial system, in US overconsumption in the real economy, low savings rate. And we had especially a huge policy mistake. You should never deal with a failing bank by putting a sign in front of the door, closed as of Monday. You have to take account of the counterparty risk first. You have to wind down the counterparty business in an orderly fashion, even if you put all owners of the institution at zero. So this shock caused a panic. And this is where I think this time is different. This time, I think we have much less of a risk that policymakers, remembering 2008, will make any comparable mistake again. And also, as I explained, I do see less of excesses in the financial system than we had 2008, and thus less need of a cleansing in that system. My take is, if policymakers continue as they have done over the last few weeks, we will probably avoid in the advanced world the real financial crisis that would add significantly to the recession, which is simply inevitable for, well, we have the pandemic, we have the lockdowns, we have to deal with it. And relative to the size of the shock and the massive uncertainty, I would say the financial system, helped by policymakers, is not coping too badly. But indeed, I do see two potential problems here, where the risk of a financial crisis is there or could come in. The first is simply the risk of a new euro crisis. We need to send a signal of solidarity within the EU and the Eurozone fast. This is not really in order to prevent a massive spike in Italian yields. Probably the European Central Bank, even without a political signal of solidarity, can do quite a bit about it. But what we are seeing is the risk that an anti-EU backlash in Italy and elsewhere may raise the perceived probability that Italy will leave the euro after, say, some change in government a few years down the road. And such a genuine risk, there is no political will to stay in the euro, is something where the central bank with financial means could not fully offset that. If it's a financial issue, the central bank can. If it's a political question, the central bank cannot fully deal with it. So this is where I see a risk that a rising perception of political risk in Italy could actually turn into a serious financial event. And if we are unlucky, a self-fulfilling prophecy. I don't think so, but I very much hope that tomorrow evening we hear from EU leaders something better than we have so far. I myself made a proposal for Corona bonds in mid-March, like a few others, and I still think would be a good idea. Now, the other risk is in emerging markets, where indeed the authors show massive outflows from those markets recently. And that is a concern for two reasons. First of all, emerging markets, at least many of them, have a weaker ability to respond with monetary and fiscal policy to the crisis, to the pandemic. And secondly, it is at least likely that emerging markets, more precisely, those emerging markets with weak governance systems, such as Brazil, that those emerging markets will take longer to get the pandemic under control, that they will be cut off from international travel for much longer than other parts of the world. And hence the risk that those economies, emerging markets with weaker governance, I don't worry about Taiwan here, I worry about Brazil, parts of Africa, some other parts of Latin America, possibly parts of South Asia, not East Asia, the risk that some of these emerging markets may indeed fall into a genuine financial crisis where the financial elements adds to the economic points that we had before, that risk is indeed so. So I do see some concern, but less so in the advanced world where so far policymakers are by and large reacting in the right way. And as to the conclusions of what should be done, yeah, more regulation, always a good idea, especially after new experiences, to look at those, including the repo market, for instance. As to the financing of government expenditure, well, I'm not a fan of helicopter money. I'm not a fan of the central bank distributing it. But I do think if there is more demand for money, as is the case after a crisis, central banks should print it. And by buying the bonds, they enable governments to spend more, which is what's happening. So thank you very much. And again, thank you to the authors for an interesting paper compiled in almost record time. And I liked reading it through most of my evening yesterday.
Thank you very much to both Dorothea and Holger. Those were actually terrific presentations in themselves, rather than just responses. A whole host of excellent questions raised. Obviously going to pass this back first to Joscha. Also, if Gerhard wants to come in, please do. I also see that there is a question from Rainer Voss on the chat function. As one of the authors, please come in at this point, Rainer, but I'm going to hand it back to Joscha first.
Okay, thank you, Simon. Okay, I will start, but I very much would like to ask Rainer and Gerhard also to reply. And I think especially Rainer can say a lot about exuberance in financial markets. First, thank you so much for your comments. Fantastic, really. And as I said, this is the draft version. And well, we've been quite in a hurry. So we are going to rework the report definitely. So your insights, your recommendations are fantastic. Very, very shortly, let me here on my notes. So for Dorothea, thank you so much. You are absolutely right. The aim of the report was not to already provide solutions, and this is the next step. Now we want to go with transformative response, and this is absolutely necessary. So this is definitely the weak side of the report. What we did is actually we thought we first have to understand the weaknesses in the system in order then to provide answers and solutions. Yeah. So you're right in saying definitely Tobin tax is necessary. I want to add just well, when you look at the suggestions for the Tobin tax in Europe, the repos are not included. And these are insights provided, for example, by Daniela Gabor, saying that there are very strong reasons for that, why they're not included. Because the interesting thing about repos is that they are mostly based, the securities, the collateral, are mostly government bonds. Yeah. So in good times, the shadow bank system provides high liquidity for government bonds. And if you start to regulate this market via financial transaction via Tobin tax, then there is, well, the danger or whatever, people are anxious that this liquidity might vanish a bit. Yeah. So that's a very interesting side note. But I absolutely agree, Tobin tax is necessary. We have to focus on high frequency trading and find solutions for that. I think especially the Tobin tax it's very easy. When you introduce it, then the problem with high frequency trading is maybe as a sideline directly. Yeah? You're right, there is a focus on the US, mainly because the US financial system is at the center of the global financial system. However, if we look at the shadow banking system, the European shadow banking market is as big as the US market. Yeah? And if we look at the Bank of England, they are the forerunner in terms of market makers of last resort. The European Central Bank is still hesitant. Yeah? It has other ways to do that. For example, via the capital union, yeah? Making it possible to have, well, what some are calling shadow euro bonds. Yeah? But this is another thing. But you're right, it's concentrated more strongly on the US, and maybe we have to look stronger at the European market as well for that. So let me go through the notes a bit. Yes, and green finance, definitely. You're absolutely right. This is, again, I mean, there's a wonderful report by the Bank of International Settlement, the Green Swan. And this has, I would say for the next report, where we look at then solution and other things, then we have to include. Now, I mean, we started with the report before the COVID-19 crisis, or the idea started before, and then when we were writing, the COVID-19 crisis was there. So we then had really to look at the COVID-19 crisis. Let me shortly go through the notes. Yes, there's disagreement. I would definitely disagree with Holger in saying whether it was a financial crisis or not. I would say yes, it definitely was a financial crisis. The difference is we saw this financial crisis only for 2, maybe 3 weeks. And why? Because central banks have learned their lessons. And they reacted so forcefully, they never done before. I mean, we now have not just lend of last resort, not just bigger numbers, more money into the system, yeah, but the market maker of last resorts facilities. Now we have a reverse repo facility, overnight reverse repo facility, and an overnight repo facility, which means that de facto shadow banks are able to, at least indirectly, have an access to the central bank reserves. This is completely new. Well, we had this for a very short time in the global financial crisis, then it was closed. And now we are living with that. So the central banks, and especially the Federal Reserve, is really putting this system or helping the system going on, yeah. And or let's take the swap lines with the other central banks. These were installed in such a short time with a lot of more money, much broader, including much more other central banks doing repos. So the Federal Reserve is doing now repos with other central banks. This is completely new. So I just want to say, so I would say there was a financial crisis, but because central banks were reacting so quickly and had learned their lessons, it was able to curb the crisis. It was not the system. The system was in a very bad state. That's my opinion. Or I think I share this very strongly with Gerhard and Rainer. And it was only because state institutions, and especially the Federal Reserve, was then reacting very, very quickly.
Joscha?
Yeah, sorry.
We've got some excellent questions coming in from some of the other panelists. I also want to bring in Rainer as well. Before I bring in Rainer, yeah, I'd like to take some 3 questions. One from Harald Schumann, one from Waltraud Schelkle, and one from Martin Hellwig. Harald, would you like to kick us off?
Rainer?
Harald Schumann?
Yes, hello. I referred to another webinar by the same organizers some weeks ago when an Italian economist from the Banking Association in Italy told us that, well, actually the most vulnerable country in the euro area might be not Italy, but the Netherlands, due to the high level of aggregated debt. That means, in particular, private households and also industrial corporations are in high debt there. And when they stop to service their loans, that maybe the banking crisis in the Eurozone might begin not in Italy, but in the Netherlands. Is this a plausible hypothesis? I would like to know.
Great question. The Netherlands as Probleemkind. Waltraud?
Yes, thank you very much for An excellent session. I'm just asking, why is it that we have to bail out these banks that have been in the repo market, shadow banks, in the same way as we bailed out the banking system in 2008-9 because it has a role for the payment system and so on and so forth. I would like to have a particular public policy rationale for doing this because, as you rightly said, Joscha, the central bank liquidity has become itself part of the problem of increased financial instability.
Thank you, Waltraud. And Martin Hellwig.
Yes, thank you. I was a bit concerned about the notion of downward spirals having just to do with liquidity. A lack of equity and deleveraging can also give rise to downward spirals. And I actually suspect that at least for the euro area, solvency issues are going to be much more important than liquidity issues, given the amounts of central bank money that commercial banks have become used to holding. Now, where does this come from? As Holger Schmieding was saying, it doesn't happen all at once. But if you have the real economy in trouble and borrowers from the real economy can't control their payments anymore, their revenues and the things that they pay, that's going to have spillovers for the banking sector. And as we heard at the last session, there is an issue about replacing such stuff by debt, replacing missing revenues by debt that may just exacerbate the debt overhang problem. And in fact, the political system may at that point be tempted to say, oh, let's have the creditors participate in the cost of all this, which may give rise to huge chain reactions. So I'd be much more worried about the issue of chain reactions from the real economy and from the political handling of the real economy than about liquidity in the financial system itself.
Super questions. Rainer, would you like to come in now and then we go back to Joscha?
Yeah, let me start because that's the one I recall best, what Martin just said. I absolutely agree with him. The liquidity is vast in the banking system. There's no problem with liquidity. And I also agree with him about the debt issue. The problem is, and that is what Holger was alluding to, I don't think that the volume of your debt is relevant, but the size of your debt service. And if you look at America, for instance, just as an example, the car loans of the weakest quality carry an interest rate of 18%. And at the end of the day, what Martin was saying is we're talking about non-performing loans. And if they reach a certain size, they eat into your equity, they eat into everything you have, you know, and that could carry, that basically spill over into the banking sector. The second thing, one remark with regard to liquidity. I think there are two aspects. One is the liquidity of the banking system and one is the market liquidity. I tend to say cynically, liquidity is something that's always there when you don't need it. That is basically my experience from 30 years dealing stuff. It's just, you know, liquidity is essential. And if you recall the presentation that Joscha has given, there is this picture of this maelstrom, you know, where everything, where the money goes down the drain. And that is basically really what's happening. And as opposed to what a lot of economists think, there is no continuous demand-supply function in capital markets. At a certain time, prices become digital. Either you get a price or you don't get a price, regardless of the size or the asset you have. And then it becomes problematic. And this is, from my point of view, what happened in the repo markets. And this is why the central bank had to step in as a lender of last resort. Not the market maker of last resort, actually. I mean, just one last remark, maybe, that, you know, the fear to lose money is essential and intrinsic for capital markets. And what we are seeing at the moment is that the central banks basically issue an unlimited put for all assets available. And that makes the capital markets as a whole dysfunctional. Basically what I can contribute to this discussion.
Ah ja, gut.
Thank you.
Können wir machen.
Joscha, do you want to come back in, because I cut you off earlier and I realized that there were a couple more things you wanted to say.
No, it's fine. Please do that, because I can't follow comments on the side. I'm not so good in multitasking, so please do that. Yes, no, maybe just to add that, of course, I don't call it the real economy. I would say it's a productive economy, because I mean, asset prices rising are real as well, if you want so. What is are real prices? So the productive economy is, of course, highly important and absolutely. And I think the decision to not stick to the black zero again was maybe the most important decision the German government did now in this crisis. Yeah, and so solvency issues are absolutely at stake. However, as Rainer was saying, solvency is not detached with liquidity. And if central banks decide, for example, with these non-performing loans, to buy these non-performing loans, then you have the first solution. When central banks decide to provide unlimited credit lines over a longer period, yeah, then you are able to at least, let's say, put these solvency risks on longer term, and then you might be able to solve them. But again, of course, you're right that just replacing the income which is lost today with a credit line is not solving the issue. And we have to think of different solutions. I think Rainer, Gerhard, and me, we're very strongly in this in the same line, saying you can't understand the productive economy without taking the financial sector on board. Yeah, the productive economy is not working without the financial sector, so you have to look at both dynamics. And maybe just to say one thing to Holger, which is I think important, because I mean, might be a thing of numbers, but you were saying that in the US the average rate of savings is now higher. That's true for the average rate, but if you go then into the different income groups, you realize that this average is mostly concentrated, the income raising, in the top 10%. And you only see any risings in the top 20. So the other 80% have lost income. So it's highly concentrated in the US in the top 10 or top 20%. And that makes a difference, I would say, for understanding the overall resilience of an economy. Okay, but maybe many points, but I stop here because there are more questions, I think. And
I'd just like, Gerhard, would you like to come in here before I turn back to Holger and Dorothea?
Yeah, thank you. Just with 2 points. First, the question by Harald Schumann. I mean, it would be a good argument to convince the Dutch to contribute to Corona bonds, and to, but I'm not sure if they will be the first in line for a European debt crisis and this, going about the sovereign bonds. That might, however, be early on when it comes to a banking problem. So I'm not sure if that argument will help us to convince the Dutch. I want to refer to the question Waltraud Schelkle raised, and I think it's a very important one. My understanding is, but I would take time after this conference to think about it more thoroughly, that the shadow banks have, as a sector, become so relevant for the functioning of monetary policy and as a transmission mechanism in the worldwide distribution of liquidity, that it is difficult to slice some parts of it out without endangering the whole system. But this is a provisional answer. You gave us food for thought on that.
Thank you very much, Gerhard. I would very much like to give Dorothea and Holger a few more minutes right at the end of the session. We've only got 5 more minutes, but I would like to bring them back in at this point before we run out of time. Dorothea?
To the issue of non-performing loans because of this now liquidity assistance in the form of loans. Of course, the liquidity assistance is just a thing to buy you time, and then if you have time, if you have bought the time, you can, of course, then KfW in the case of Germany, for example, or other development banks in other countries, they could think of changing it or transforming it into grants if necessary. But it could not be just a lump sum subsidy for all. It should be really be checked whether the firm is really at the brink of insolvency but still valuable, and then a grant, changing it, the loan into a grant would save the firm. So, but right now we have our time with the loans, and as I understand, they are not. There is no repayment for at least one year. So firms do not have to service the debt for 1 year. So this is, I think, one way out of this debt overhang. And the other thing, with respect to Waltraud, why can't we let them just go bankrupt? Banks invest in shadow banks. We all invest in shadow banks. So part of the financial system participants would simply lose a lot of money, and that would have, of course, spillovers to the banking system, and they would be very severe. So I think it's the best thing what we can do now is that central banks step in order to save us all.
Holger.
Yeah, central bank stepping in order to save us all, that's almost the point to be made. Joscha, listening to your comments now, we are not quite as far apart as I thought when looking at your paper. If your COVID-19 financial crisis is largely the first 2-3 weeks of significant market moves rather than a description of where we are now, then at least we agree in the sense that policymakers have prevented what could have been a much worse outcome. My view is that unlike 2008, 2009, when we had a huge financial issue turning into a huge real economy crisis, this time we have a huge real economy issue, which fortunately, thanks to policymakers, is not turning in the advanced world yet, at least, into a huge financial issue on top of that. And my reading remains that relative to the real economy half freezing, the financial market reaction, including the dysfunctions in the repo market and others, was not really extremely severe. I agree with the need for some regulation here, of course. As to bailing out, what precisely do we mean by bail out? What we see is that indeed, just like the central banks occasionally have to be the lender of last resort, I very much agree with the conclusion of the paper. Central banks also have to be the market maker of last resort in those parts of the shadow system, which is relevant for the transmission of monetary policy. But as far as I see, it's not yet that we are bailing out banks in the sense of, or shadow banks in the sense of the government putting in its money to rescue the institutions, but rather in the sense of central banks taking over a deal of their function because it's relevant for markets. One last comment, Joscha, you're absolutely right. The savings rate in the US is an aggregate. There are very interesting and not all, and to some extent, negative distributional aspects in there. We may have to discuss those on a separate conference. They're worth going into, but it's probably that these 20% at the top with the rise in the savings rate are by and large also the ones most engaged with the financial system and hence most relevant for the question how stable or unstable the financial system is.
Thank you, Holger. This has been a super high quality discussion. and it's certainly given me, and I'm sure many other people on the call, much to think about. Thank you to the authors of the report, to the respondents, and to the panelists for putting such great questions. We're now going to take a short lunch break, 30 minutes, unlike the normal sort of hour and a half at a physical rather than a virtual workshop. After that, the discussion is going to remain focused on central banks, but on the particular question of helicopter money. We have a terrific panel for that, and I expect that the quality of the discussion will be maintained. I would like to thank you all again, and hope to see as many of you as possible rejoining us in 30 minutes' time. Thanks very much.
Thank you so much, Simon.
Thank you.
Thank you.